Hello, welcome back. So now we need to prove um, that our Sharpe ratio has improved by adding active portfolio to our passive portfolio. Uh, so basically uh, the weight of our actively analyzed stock, right? If our active portfolio consists of like three stocks, actively, analyze three stocks, the weight of stock A, let's say it's three stocks A, B, C, the weight of stock A in this active portfolio should be uh, determined by the information ratio of stock A over the sum of all weighted average of all the or weighted sum of all the information ratios of stocks A, B, and C. That's what it means, The weight of the active portfolio is basically weighted average, right? I should say weight, I believe, weight of active portfolio. Maybe I should. This is a better way of doing that. Weight of active portfolio. Subscribe. Right? And that makes sense. And think about it. If the alpha of stock A increases, then it will increase the weight of A in the active portfolio. Whereas if the the variance of the residuals, if in other words, there's too much firm specific errors or from specific risks, too much of them, then it will automatically, lower the weight of the stock A in this active portfolio, right? In other words, the higher the information ratio, the greater the weight of the this particular stock in the active portfolio. So the active portfolio, let's say, we have included Google. And let's say there's only Google in the active portfolio. Still, if Google has significantly, we already understand if Google has significantly positive alpha, right? And it will improve the Sharpe ratio over the passive portfolio's Sharpe ratio. Okay? So the portfolio formed by optimally combining analyzed stocks, that's an active portfolio. Instead of Google alone, let's say a portfolio of several stocks, including, let's say, Dell. So then active portfolio plus passive portfolio or passive index portfolio is optimal risky portfolio, right? So now we need to determine the exact composition of active portfolio as well as the alpha, beta, and standard errors. I mean standard deviation of errors. Standard errors. Standard deviation of error terms, standard deviation of residuals are simply called standard errors, right? In other words, yeah, standard error is the standard deviation of error terms. Actually. And then, once we have determined that, use alpha, beta, and standard errors of active portfolio to obtain the weights of optimal risky portfolio and Sharpe ratio of optimal risky portfolio. Okay? So this is what Trainer Black model does. And it was actually developed by Fisher, Black, and Jack Trainer. Actually, Fisher Black is one of the very renowned name in finance. His name will repeatedly come up later, like Black and Scholes model, option pricing model, Black and Scholes, and that Black is actually Fisher Black, Scholes, Myron Scholes, and they won Nobel economics in 1990 something, I believe, 97 or 96. And then so we'll have to take a look at the actual example that they used, to actually improve the Sharpe ratio of, optimal risky portfolio and the weight of, active portfolio out of the optimal risky portfolio and weight of, each Google and Dell in active portfolio and things like this. And that's table. Actually, that's table 6.2. Example 6.5, table 6.2, and we're going to get to that. I mean, this is too too much fine print. It's hard to read, but I will show you the Excel file for that. So, so we will have to estimate to do that, to conduct that, research, to confirm and verify and confirm this theory. We'll first need to estimate information ratios for Google and corresponding ratio for Dell. So information ratio for Dell, and some of these ratios for all stocks in the active portfolio. And if we have more stocks, yes, there will be. But in our example, our active portfolio consists of only Google and Dell. So it's going to be. Now you might wonder, if we are doing only Google and Dell, aren't we too concentrated into one sector? Information technology. Oh, no. Don't worry about it. That's why we have passive market portfolio. And to passive market portfolio, we're just adding a particular sector. I mean, it looks like a particular sector because Google and Dell are both. I mean, they are in information technology. Google is a software. They are more software company. Search engine, and Dell is a hardware company. And of course, they are in both computer and software industry, and they must be highly correlated. I mean, if you're only putting all your money into Google and Dell, then this is not a well-diversified portfolio, and you don't want It's like putting all your money into one, all your nest eggs into a single basket. And that is a no-no. But don't worry about it. We are not putting all our nest eggs into a pool and into one basket because we have already a passive portfolio. And, and then, we are just adding, uh, uh, Google, this active, portfolio to the, and even our risky portfolio, optimal risky portfolio will not only consist of, passive market index portfolio, plus, these active or stocks, active portfolios for stocks, plus there will be, a bond portfolio, right? And that's our optimal risky portfolio. And plus, we will have risk-free assets, right? Remember T-bills? And then that makes up a complete portfolio. Remember that? So we're just, starting from, a complete portfolio, broke it down into T-bills and, active, optimal risky portfolio. And then we broke down optimal risky portfolio into a stock portfolio and bond portfolio. And now we are breaking down that stock portfolio into passive index portfolio and this active portfolio. Make sense? So lots of, weight, distribution, determining weights. In other words, we determine the weight already between, weight Y, remember? Determining the weight of weight between, T-bills and, a optimal risky portfolio. And within the optimal risky portfolio, we also had to determine the weight between, a bond portfolio and stock portfolio. And stock portfolio, we need to determine the weight between the passive and active, right? And then within the active portfolio, we must determine the weight between Google and Dell. Right? Makes sense? So then, think about it. Weight of this active portfolio is actually the, as I said, weighted average. I mean, it's just, information ratio of Google plus information ratio of Dell. And you might say, this is not exactly information ratio, right? Because information ratio is standard error in the denominator, but here it is actually the variance, right, of the error terms. Then what is that? That's like Sharpe ratio. Actually, you don't call, the term Sharpe ratio is reserved only for portfolio, not for individual stocks. Individual stocks, that's information ratio or price of risk. But it doesn't really matter. I mean, they are all basically the same concept. It's, return risk ratio, basically. So now we need to determine the weight, right? So to determine the weight, we'll have to, for weight of Google in the active portfolio, right? Will have to be information ratio of Google over the total weight, total information ratio of the active portfolio. And then, the same thing for Dell. And then stocks with higher alpha value calls for a higher weight to take advantage of its attractive excess return. Yeah, expected excess return. True. But high variance, residual variance, high residual variance, leads us to temper our position. In other words, contain our position, right? Temper, contain, right? Uh, like moderate, right? Moderate, temperate, moderate. Uh, Contain our position, right? In stock to avoid bearing in that stock to avoid bearing from specific risk. Okay, or limit or contain. In moderation, right? It's like contain your temper, right? Contain your temper, or in a stock in that stock, right? Come on. And alpha and beta of active portfolio are basically weighted average of each stock's alpha and beta, and the residual variance uh, of the active portfolio is the weighted sum, which is the same thing as weighted average, right? Of each stock's residual variance. And you see why there's a reason why we use a residual variance rather than um, a standard error, because when you combine these, combine standard deviation of A and standard deviation of B. You remember, it cannot be just simply standard deviation of A and B. Um, it will be a variance. There will be a variance because there will be a covariance and correlation between the two, right? So it will have to be variance, right? When you combine two standard deviations, it cannot be a simply uh, so that's what it is. That's what it is saying. Active portfolios alpha is weighted average of two alphas. Google's alpha and Dell's alpha. Beta of active portfolio is weighted average of Google's uh, beta and Dell's beta. And residual variance of the active portfolio is the weighted average of the individual variances, right? Then, given these parameters, we need to determine weight of active portfolio and optimal portfolio and Sharpe ratio. So this is the footnote. I had to put a footnote like as a separate page because it's it deserves dedication, right? Its own right. I mean, but it's what I have been explaining all this time. So just run through that, easily. Next, so we are actually looking. We're gonna have to look into actually the uh, this table 6.2, where they have actually calculated, alpha and beta, and residual variance of Google, um, Dell, and passive market portfolio, and uh, the combination of them, all of them. So, but it's too small. I mean, uh, you can't actually. I mean, if you have your book, you can look at your book, but still, on a slide, this is too small. So what I did was I built this. Actually, this was already built, but I uh, whatever is given from the original uh, data source, I'm not gonna just uh, walk by it, as without uh, turning every stone. I have to check everything to make sure if it is all uh, correct, and if it all makes sense. So, oh well, you're not even looking at that. Um, I'll have to stop sharing. I'll have to share this Excel file, and you should be able to see that just about now. Okay. All right, you see this? Okay. So this Excel file is basically table 6.2. First of all, we have, we'll have, three panels. Panel A, which is input data. Panel B, um, having only Google in the active portfolio. And panel C, having both Google and Dell in the active portfolio. Okay, we see the weights of all of them, and how Sharpe ratio has improved, and etc. etc. And so first of all, let's take a look at the input data, panel A. So we have, this is our S&P 500 is our passive portfolio, and our risk premium is 0.7%. I don't know if it is 0.7%. Somehow, it's very low. I mean, if it is if the market is only doing 0.7% better than the risk-free return, um, that was given already, right? Standard deviation 2.31. So Sharpe ratio is this divided by this, right? Okay, that's the Sharpe ratio, right? And then market doesn't have alpha. Beta of market is always one. They don't have necessarily. So let's take a look at the Google and Dell. Google's risk premium is 2.2, which is that's alpha. Google's alpha basically. It's not alpha. You have to subtract risk premium of the market, and then you will get. But again, risk premium 2.2, standard deviation 11.39, Del 1.74, standard deviation 10.49, Sharpe ratio not applicable. Why? Because it's not the Sharpe ratio for individual stocks. It's the info ratio, right? So if you take a look at the info ratio, right? This divided by residual standard deviation. This is just the standard deviation of the return at the residuals. Okay. So alpha and the residual standard deviation, which means actually what it's standard error, right? Standard deviation of error terms. So should I draw, or yeah, maybe I will. Standard deviation of error terms, right? And then the same thing, but alpha or residual variance, right? Standard deviations, standard error squared, right? And then squared, right? So here. Okay. Now, the same thing for, of course, the same thing for Dell. Now, let's think about it. If this is a risk premium of Google, alpha is when risk premium of this is what you get when risk premium of the benchmark market portfolio is 0, and that was calculated by regression. It was obtained by regression. Now, let's move on to panel B, which is optimal risky portfolio, optimal portfolio with Google only in active portfolio, right? So now the Sharpe ratio of the active portfolio is basically index Sharpe ratio squared and plus Google's information squared, right? And take the square root of that, because Sharpe ratio is so if you do that exactly, that's what it is. That's what is done here. And you will see, I took the square root of that, right? And, take square term, and then take the square root of that. Sharpe ratio has definitely improved, right? Adding Google to passive index portfolio improved, right? Sharp ratio. And then what about the then weight? Let's think about the weight of the and we know the weight information ratio. I mean, it's not exactly info ratio. We know it's the uh, alpha over error variance, right? Residual variance over the total, right? Uh, uh, info ratio, right? So total, what's the word? I'm trying to, but let me just write it. It's easier to write. Freehand is always the most difficult thing. This is Google's error, right? Squared. Then index risk premium, right? Okay. So once we found the weight of the weight of Google in optimal portfolio, then we adjust it for beta. Remember, we have to adjust it for beta. So let's take a look at the results. So if you do that, C14 is of course Google's info ratio, right? Information ratio, C14. C14, right? And then B7, that's passive. Plus, index risk premium, right? Market risk premium over, right? The residual variance of the market. That's, that standard error squared. Standard error squared is the uh, error variance of the market, or called, residual error and residual in the same thing because it's the residual of the regression or the error of the regression line. Um, so that's the weight. Then we adjust it for Google's beta. So adjusting it for Google's beta. First, that's not Google. That's the C22 is Google, and so that's the passive weight of the passive portfolio. Maybe I better. So that's exactly how the adjusting for beta is that um, weighting the optimal portfolio weight of Google in the optimal portfolio 1 plus weight of Google times 1 minus C11 is what? Google's beta. C11 Google's beta, right? Okay. Of course, Google's beta was calculated by regression, right? Of course, they were. Uh, and so now we extended to two assets in the active portfolio, both Google and Dell. So we extended. Now we're running out of time, so I cannot go through everything. But we know how it is done now. Okay. C26E26. First of all, um, uh, alpha over residual variance. We did that already. C14, and we do the same thing. B7, we know that's B7. And variance of right. So once it's done, right, then sum of these two is the weight of the active portfolio, right? And then uh, so oh no, what's that? And then again, out of the entire, active portfolio, it will be, if you divide that by active portfolio, then the weight will be like that. And then, of course, then sum of these two, right, will be okay. Now, and this is the weight of the active portfolio. Then what does that mean? Then passive portfolio, weight of the passive portfolio. Will be then 1 minus this one. But let's see. First of all, and alpha of Google, alpha of Dell, and weighted, right? They are weighted, and so weighted average of that or weighted sum, they mean the same thing. Beta, also the same thing. The weight of Google and weight of Dell, and running out of time and I'm pressing on anything. Weighted average, right? And then residual also weighted. Okay. And then weighted sum. And now Residual standard deviation is the square root of that. So square root, raised to half power is square root, right? And then finally, the info ratio of our active portfolio, information ratio, right? Calculate that. And then Sharpe ratio of our, then the Sharpe ratio of our, the Sharpe ratio of our optimal risky portfolio is now 0.24. And I've been telling you, Sharpe ratio of optimal risky portfolio is the same thing as the Sharpe ratio. The improvement in the Sharpe ratio of optimal risky portfolio comes mainly from the active portfolio, because passive portfolio. What was the Sharpe ratio of passive portfolio was like 0.16, and then when we had added only Google, it increased to 0.28, 0.20, and then when we added Google, even Dell, it improved to 0.24. Okay, and the weight of the active portfolio, and once it is adjusted for beta, right, and it comes to this, and then weight of weight of active portfolio times weight of stock in average active portfolio. If you do that, it took too much time, actually. So you can, in summary, you can tell that the you will see that the optimal portfolio invests 91.73% in active portfolio and 8.27% in the index. This large tilt, you see 90% into active portfolio and only 10% into index. This large tilt, is it acceptable? Yes, it is acceptable, because active portfolio the residual standard error of the active portfolio is far less than the residual of Google or Dell, respectively. In other words, what that means is, active portfolio, by combining both, Google and Dell, the firm-specific risks drop drastically, and just individually, Google firm-specific risk of Google and Dell, respectively. Okay, because you can remember, Google and Dell by themselves, their standard deviations were like what, 11.39, 10.49, but when you that's from specific risk, and when you combine them, uh, the standard deviation of the active portfolio drops drastically. Ah, ay, ay, right? It drops drastically. Then a standard deviation of Google or standard deviation of Dell, respectively. Okay. And also, optimal portfolio weight in Google. Google alone, Google is 50.94% and Dell 40.79%. Weight in Google is greater than uh, weight in the active portfolio without Dell. Because previously, what was the weight in Google in an active portfolio? 43.64. But without L, only 43.64 in Google, and the rest in the passive portfolio. Now, Google's weight actually increased. This is the result of diversification within active position that allows a larger tilt toward Google's large alpha. So, in other words, to take advantage of Google's large alpha, that is totally justified. I think, okay, I'll have to stop here because it's been like, this is a very long video, 45 minutes, I believe. Alrighty, I'll stop recording and I'll stop the video here, and I will see you guys in the next session. Take care.